All right, so hello everyone. My name is Mridul. I am a consultant here at Desvelado Advisory, and today we'll be going through a training module on beta and how to calculate it. We will see how it is used in later modules as we go forward with this series of DCF modeling, and hopefully you guys will be able to practically construct financial models for DCF evaluations yourselves post this series. All right, so let's dive right into it. Okay, so we are covering here something called as beta. And what is beta? Beta is basically a measure of sensitivity of a stock to the index. So basically, if we look here at Investopedia, it says beta is a measure of stock's volatility in relation to the overall market. So we want to see how our particular stock, let's say any company, let's say Infosys or TCS, how the stock there is behaving to in response to, let's say, Nifty 50 or maybe the Nifty Tech, Nifty IT indexes. And with that, we want to understand what kind of movement does the stock give should Nifty move in a certain direction. Okay, and by how much is it mathematically, how much more or less is it responding to the movements in the sector or in the market that it is a part of. So what is beta and why do we calculate it? Just a quick understanding of where it is utilized. So to begin with, we look at the cost of equity. So beta, since it's a measure of volatility of stock, then it automatically becomes a part of cost of equity, which ultimately forms the part of weighted average cost of capital. We'll not dive into weighted average cost of capital right now, but here we have a methodology for calculating cost of equity, which is called as capital asset pricing model. In that, beta plays an important role in telling the investors how much more they should expect from a stock in terms of returns over and above what the index in which that stock is paying above the risk-free rate of the country. So let's look at how we are going to calculate it, and then we'll come to adjusted and levered and unlevered beta. And this is the main part here. So for this example, I've taken the financial model of Western Carriers India Limited, which is basically a company in logistics, and we've already created a financial model on that, so we'll just go with what we have done. So in order to calculate beta, we basically need two sets of data. One is the set of stock market movements in the stock, and the other is the movement in the index. We look at how to calculate the sensitivity of this to the sensitivity of this. Okay. So first things first, how do we identify how to form our index, and why are we taking logistics index as opposed to Nifty 50? See, in most instances, what you will be doing is calculating the sensitivity of your stock in relation to the sensitivity of the index that stock belongs to in terms of industry. Ours is the logistics industry, so we have taken the logistics industry index. Some of the industries don't really have a readily available index in them. So for example, you may have Nifty IT for IT companies, you have Bank Nifty for banking companies, but I didn't really have a logistics Nifty for logistics companies. So for that, what we will be doing is we'll go to this website called as Tijori Finance, and we'll, instead of features, we'll actually go to markets. Right, so you can see here what this website does is basically it gives us the names of publicly listed players in that particular industry. You will see that other than Nifty 50, Nifty Next 50, Nifty Mid Cap, Small Cap, etc., it has actually given us niche sectors based off of the products or the services that is being provided under each particular sector. So you can see here there's fertilizers, hospitals, dyes and pigments, packaging films, media and entertainment, communication, etc. And if you were to look a little further down, we have logistics. We can actually just simply search logistics. There you go. Tijori India Logistics, and you can see that it has given us a bunch of names that allow us to look at the logistics sector. Now, the reason you don't need to worry about every company here is because as you go, you'll see that some of the companies are only contributing, let's say 0.02%, 0.06%. So they're not really material to our analysis of the index. So you can look at those companies that form 90%, 80%, 95% of the index. That is up to your discretion, but of course it should be covering a reasonable majority of the market. So you basically, what you do is you copy this here. Okay. You go to your model, add another sheet, and you simply just paste this here. Okay. It's taking a time because some of the things there were images. So let's just wait. All right, so we have the data here. We can see that we just need to clean this up, and you don't need to do a lot of things here. You can just simply do Alt HW so that it gives us the names here. It has been properly named. To expand the cells, you can do Alt HOI, and now we have the names. And then other than this, the market share, this is based off of market capital, by the way, which will mean that however much their shares into share price is currently, this will give us the market price. Okay, market capitalization, and that is what is defining their share of the market right now. Okay, so let's just get rid of all of these things. We'll simply go and delete, and you have gotten rid of them. Okay. All right. So now we have the names in the index. Okay. Right. So these are actually not all the names that you're going to be using. Like I said before, there is 0.2% contribution, 0.06% contribution. So I don't need all of this. So let's clear some of the companies that are not really going to help us. You just apply a filter, Alt H80. So let's look at, and all I'm going to do is I'm just simply going to sort this from highest to lowest here. So let's go largest to smallest, largest to smallest. Okay, and just remove the filter after you've sorted this out, and we can see that logistics is actually not been sorted out. So let's just say company name. I'm just trying to apply the filter in one field above and not at a company name. I don't want my filter to read these as headings because they're a part of my data. Okay, company name, market share, move it, apply Alt AT. Now you can see I have my market share here. The filter has been applied to the topmost level. And then we go largest to smallest. As you can see, Adani Port and special economic zones actually contributes 49% to the index, so that is a major player. Then Container Corporation of India does another 12.34%. So what do I want to do is I want to see at what point after covering which company does this set of companies constitute at least 90% of the entire market that has been given to us by Tijori. Okay, so what I'll do is I'll find a cumulative market share. So how much do these companies? Let's see. So over here I have 49%. So just Adani. Up until Adani it is 49%. Then I go forward and I add to the market share of the companies that have come before it. Okay, so I know now that from Container Corporation of India and Adani Ports together contribute 61.57% in the entire index. And let's just simply drag this down, and I see here that at my 90% cutoff I have the TCI Express, and beyond this I don't really need any of this. So I can simply delete this. So this is the data I'll be using to calculate the movements of my index. So over here, none of this is useful to you. This was just a reference point to tell us that, hey, these companies are covering 90% of my market, and these are the shortlisted names for my index. Now, where to actually get the data of index? So unlike other stock markets, so unlike Nifty, we don't have a readily available data for Nifty. What we will be doing, however, is we'll use TradingView in order to calculate the movements in this index. So TradingView makes it easy for us to give us price movement by constructing an index or customizing an index based off of the names that we provided. So let's go into the candles. All right. So as you can see, it opens on Nifty 50. What you can do is just quickly come here and click here, start writing Adani ports. Apologies, Adani ports. Okay, and instead of hitting enter or selecting Adani ports, you don't click on it or do not hit enter. Just go to Adani ports so that it is highlighted, and as you can see in the top bar in the search bar, I have NSC colon Adani ports, and then you hit a plus, and then you type the next company, Container Corporation of India, which is this one. And as you can see, it is now basically creating a fresh ticker symbol for my index. So I do this, then I add delivery. All right, select delivery. Then you add another, which is Blue Dart. Here you go. Then you add another, which is Aegis Logistics and GE Shipping and All Cargo Logistics and Cochin Shipyard and TCI Express. There you go. All right, once you've done this, again, now you can hit enter and you will see that TradingView has actually created an index for you. All right, so now you can basically look at the stock movements. All right, so all these companies, if they were to form an index, this is how it would move. TradingView has provided this excellent service for us to combine it in one. Now, to get this data, we basically want to go into a number of days, and then what I want to do is, you can also set it for weeks or months depending on how you're comparing. In my case, I believe it was for months, so I can go and select 1 month here. So instead of daily candles, it'll transform into monthly candles, and as I can see, there are quite a few. I guess approximately let me see here. Yeah, there's about 2 years of data here since May 2022. I'll go here and I'll export the chart table. Now you can select ISO timestamp and export the data. Now it requires a premium version of TradingView, so we don't have TradingView here personally, but you can start a free trial and get the data from that. I personally did the same to calculate or get the data for the peer companies or index like that. So this is how the data will appear. All right. Obviously, you'll have to rearrange it. For me personally, you arrange it from oldest to newest. So it should be going down from oldest here to the newest data available, and this is again going to be the points of index, the data of index against which the sensitivity of the stock needs to be looked at. Okay. Similarly, you can get the data. I would suggest that you get both of the datas from TradingView so that there is no mismatch in dates. Okay, I personally face this problem while calculating beta. So you go to TradingView and then you go to WCIL, Western Carriers India Limited. Now, personally, Western Carriers has not been listed for a very long time, so we had to look at what to do with this particular limitation. And to resolve this, what you can do is you can use the beta of another company, or you can use the stock data of another company that is currently doing just as much in revenue as WCIL. Okay, so you can look at maybe Ritco Logistics, as we saw here. Yeah, so you can see that I took a comparable for Ritco, right, and use that data in tandem with my index to be able to calculate beta, okay, for stock, which is going to be utilized after some small modification as the beta of Western Carriers. All right, so if you look here, we've covered this pointer, what to do if the data is unavailable. So if the data, if the index is unavailable, like you don't have Nifty IT, you don't have Nifty Bank, unlike those preset stock indexes or indices, if you do not have that kind of data, we can switch to Tijori, and it will give us a list of names that will allow us to find or create our own index in TradingView, and then further download the data of movement in that index from there. And then in case your stock data is not available, then what do? We go and we look revenue wise a comparable company that can help us look at its price, and we'll use the beta that we obtain from that company after certain adjustments, and we'll come to the adjustments really quickly. All right, now let's look at least theoretically look at what is adjusted beta. So now that we have the stock data and we have the market data, let's quickly look at how we will calculate the beta here. Okay, so to calculate the beta, we look at we arrange the data of the industry and we arrange the data of the stock. Now, beta is not directly calculated among prices, it is calculated among returns, because what we are trying to find out is, in this formula of capital asset pricing model, risk-free return and the return of the market minus risk-free return, how much more should the sensitivity of my stock enhance or suppress the returns on that premium, equity risk premium, RM minus RF, risk of market minus risk-free rate. So how much should this beta, should it be more than 1, it will magnify that premium. So the equity shareholders will ask for more money than what the market is returning over and above the risk-free rate. And if the beta is less, which means my stock is less sensitive to the index, which reduces my risk, they can actually ask for less than the premium that the market is generating over risk-free rate. All right. So over here, just 1 second. Okay, yeah, so like I said, so we'll first calculate the returns of the index movement and the stock movement. So index movement here, as you can see, it's a simple formula. You take the next price and you subtract the previous price and you subtract 1. In percentage terms, how much it was 2%, and then so on and so forth. Similarly, for the stock price movement, stock price returns, we look at the same things that are done. All right, now let's come to adjusted beta. So why are we adjusting this beta, and what is the meaning of this? So what happens is, research shows that over a period of time, beta tends to gravitate towards 1, and that is because the beta of industry with itself is 1. So how is this stock price or index value moving along when compared to itself? It is moving equally, right? So my stock index tomorrow moved by 10%. So when we compare with logistics industry beta, so when we compare an index movement with itself, the sensitivity is obviously 1. They will always move equally. Okay, something always moves equally with itself. So what research has shown is that over time, the beta of the stock tends to gravitate towards 1. We don't have to consider that, hey, in the very next year it'll start matching the index 80% or 90%, but we take a rough estimate and we say that some adjustment is needed, that because we are trying to, with the financial model, we are trying to forecast things. So everything that we are going to be doing, it will be for the future. So in future, we know at least some drift will happen of the current beta towards 1, so that it starts to behave like the index. Okay, it doesn't have to be right away, but over a period of time, it'll slowly move towards 1. So that is why we adjust this and capture the beta drift. So how do we do that? So we look at the raw beta here. Ignore the word levered. I'll just come to that later. So we look at raw beta here. Okay, and then we adjust market beta. Okay, so calculation of beta. How to calculate the beta? Beta is basically, since we are calculating the sensitivity, in graphical terms, sensitivity is measured by the slope of the line that is generated by regression of this with this. So if I was to run a regression and that regression was to represent all the points in a line, then the slope of that line is my beta. So that's more mathematically, that tells you more how beta is taking place mathematically. But in our case, we just basically want to find the slope of a line that is found, that can be found in a graph that is made by these two sets of data. Okay, so whenever we try to find the slope of a line, we always need an independent variable and a dependent variable. So remember that the index is not going to move because the stock moved. The stock moves because the index moves. So here logistics industry will be our independent variable, and Ritco logistics will be our dependent variable. Now when we apply a formula for slope. So this will be our x and this will be our y. All right, and we look at how to calculate. Okay, so returns of these logistics industry index is what we'll plot on the y-axis and x-axis, and Ritco logistics is what we plot on the y-axis. Okay, once we put this in, we don't have to go through too much of trouble to find slope. We don't have to create graphs, etc. Simply apply the formula for slope, and you do y-axis. The known y's is the dependent variable, which is Ritco logistics, and the known x's here are the independent variable, which is the logistics index returns. All right, so that slope will give you the levered raw beta. Okay, that will give you the levered raw beta, and then from there we assign weights. Okay, so market beta, as we've discussed, it'll of course be 1. And now we'll assign weights. So different research houses, different companies do it differently. We just take 75%. That we say that 75% of this 1.29 will stay the same, but 0.25%, 0.25 or 25% of this 1.29 slowly gravitate towards 1. All right. So we're basically calculating a weighted average here. And how do we do that? We basically multiply 1.29 by 0.75, and we say that, hey, as we move forward, it'll only be 75% of 1.29 and 25% of 1. Okay, so as you see, our result will actually be less than 1.29 because we are trying to move it down to 1. Okay, so here you'll see that our adjusted beta, again, this is still levered beta, and I'll come to what levered and unlevered beta is, will be 1.22. Okay, so this is what we will be using. Coming to our sheet here, you can see that we've used 1.22 as the levered beta. Now, what is levered and unlevered beta? We're coming to the end. So, yeah, here so whenever a stock is responding to the index, each stock has its own amount of debt and equity in it. Okay, so every company takes a different approach to how much debt they should take and how much equity they will keep. So how much are they funding themselves and how much they are borrowing money at a certain interest rate from the market. So both of these things together make a factor in impacting the movement of stock in relation with the movement of index. And whenever we look at any levered beta, it's basically saying that, hey, if this is a levered beta, it means that right now, since we got Ritco's levered beta as 1.22, it means that, hey, right now Ritco behaves like this. It has a beta of 1.22 because it has a capital structure or a debt equity ratio of 0.26. Right. Similarly, if we look at Container Corporation of India, it has a levered beta of 0.88 because it has a capital structure of 0.02. Right. So as you change the capital structure, you will see that there is a change in beta as well. Okay. So how do we remove this impact of the capital structure from the calculation of beta? This will give us the unlevered beta of the company. So what do? We basically take this particular beta, we look at what their debt equity ratio is, and we divide this levered beta by 1 plus the debt equity ratio of the company. So remember, we are dividing this to remove the impact of the particular capital structure of the company. Okay, we want the beta to be pure. Had there been no differences in capital structure, what would the beta of that company be? Okay, purely on business fundamentals as opposed to the capital structure impact. Okay, so we take the J8 or as you can see the levered beta, and we divided it by 1 plus the debt equity ratio. Now there's one extra element that you must be seeing here, and note that is the tax rate. Now for debt, what happens is, debt in itself, when we pay interest is a tax deductible expense. So whenever we pay interest, it shows up as an expense on our income statement, and that allows us to reduce our profits before we pay tax on them. So when we pay tax on reduced profits, we also pay lesser tax. This amount of tax saving because of the interest payments being counted as an expense is called tax shield, and that tax shield also always features along with debt equity ratio. So since when you'll see that this particular number will reduce. So if I was to look at here, okay, we do 1 minus the tax rate, which is basically to say that hey, only this particular debt equity ratio is only actually impacting about 74% in my beta. And now that I'm removing the impact, I'm not going to remove the entire debt equity ratio, because due to the interest payment being counted as expenses in my income statement, I am saving some tax, and so this debt equity ratio will only impact about 74% in my stock movements as a part of my capital structure. So I'll simply, when I divide my levered beta by 1 plus debt equity, I'll not use the entire debt equity, I'll use 74% of that debt equity, and that's the only impact that needs to be reversed. I don't need to remove the entire impact of my capital structure here. Alright, once you do that, you will see that you now have arrived at an unlevered or pure beta. These betas are more comparable than these betas because they are now free of any impact of the capital structure on the company. Okay, here you can see that the amounts might not be very different just because the debt here is not a lot. The debt equity ratio is, it seems like in the logistics sector they don't take a lot of debt. Alright, so this gives us the unlevered beta. So what do we do once we have the unlevered beta, right? If you look closely at the formula, we have used a levered beta, but it is not the same as this one. So what has happened? Why did we calculate the unlevered beta? So once we've removed the impact of this particular debt, capital structure from our levered beta, what we do is we are now going to reapply the impact of our company onto that beta. Okay, so I did not have the data for Western Carriers, but I had the data for Ridco Logistics. I have now removed the impact of debt to equity ratio of Ridco Logistics on its beta, and now I'm going to apply the effect of my debt to equity, of Western Carriers debt to equity, on that pure beta that we saw. Alright, so we'll now relever the beta, and we look at what is going to happen here. So I'm going to basically pick up the unlevered beta of Ridco Logistics, which was my replacement company for Western Carriers, and now I'm going to apply the debt to equity ratio of Western Carriers onto that particular beta. Okay, so how do I do that? What I had done to unlever the beta, I'm just going to flip it. So instead of dividing here by 1 plus debt to equity into 1 minus tax rate, I'm just going to multiply it by 1 plus debt to equity of Western Carriers multiplied by 1 minus the tax rate of Western Carriers. Okay, so to unlever Ridco Logistics beta, as you can see here, we used the tax rate 30%. We used the tax rate 30%, and we removed the impact of debt to equity ratio of 0.26, and that gave us a pure beta of 1.03, and then we re-levered it or reapplied the debt to the impact of debt to equity of Western Carriers onto the pure beta that we had achieved from Ridco Logistics. So there it is. That is your calculation of beta, and this is how you basically move forward with this particular element. Again, there is a separate segment on this because the calculation was a little cumbersome. You can also do this for the entire industry. In fact, you should, which basically gives us a set of more comparable data if we wanted to look at it. So here you can see I've taken everything from the peers of Western Carriers and tried to calculate their unlevered beta, so that I just have a fair comparison as to what is going on. In most cases, you will see that right now Ridco Logistics and Western Carriers both have higher beta than their peers, higher unlevered betas than their peers, and that is probably because of their financials as opposed to their capital structures, since we have removed that impact. All right, so there you have it. This is how you calculate this particular element beta of the formula while calculating cost of equity. We'll look at we'll take a more comprehensive look on cost of equity and cost of debt in the next module, where we calculate weighted average cost of capital. All right, so there you have it. That's how we calculate this particular element of the cost of equity. So beta as a part of cost of equity is now complete. Hopefully you'll be able to calculate it. And as we move forward, we'll look at calculation of weighted average cost of capital and also cover cost of debt and cost of equity in its entirety. All right. So thank you so much, and I hope you have a great rest of the day.